Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and I'm excited to share our insights on the quarter that just wrapped up, ending June 30th, 2025. In this video, we're going to dive into current market and economic conditions, explore the impact of the newly passed Big Beautiful Bill, discuss our economic and market outlook, and address the potential return of inflation. Now, the second quarter certainly brought its share of market volatility. As we anticipated, the markets took a bit of a breather after that strong two-year run. The initial catalyst? The renewed discussion around President Trump's tariffs. However, just as it seemed we were in for a prolonged challenge, the rhetoric shifted and President Trump began to ease his stance. This quickly provided markets with what they crave most: certainty. And as that certainty returned, so did market stability. Now, it's worth remembering that when the tariff talks first emerged, many firms predicted an imminent recession, forecasting as many as 4 interest rate cuts by the Federal Reserve this year. While we didn't share that pessimistic view, we did expect tariffs to mute economic growth. Fast forward to today, and most of those recession forecasts have been significantly scaled back, with many now anticipating only 1 or 2 rate cuts. Frankly, based on how we see the economy unfolding, I'm skeptical of more than 1 rate cut at this point. Constantly shifting tariff policies create significant uncertainty for supply chains, leaving businesses scrambling to pick up the pieces. Now, this extra effort diverts time and energy that could be better spent elsewhere. We expect to see the initial impact of tariffs from earlier this year show up this quarter, potentially as early as August. While we anticipate these tariffs will present a stumbling block for the economy, we don't believe they'll become a roadblock. Even as I record this, President Trump is announcing more tariffs on countries where he seeks change. Will these be absolute, or are they a means to an end, ultimately focusing on increased investment in the U.S.? Only time will tell. One key area we'll be watching closely is the impact on corporate profits. While increased revenue might be on the horizon, will it translate into higher profits? The companies best positioned to thrive will be those truly adept at managing both their top and bottom lines, successfully increasing sales while muting the impact of rising input costs. The Big Beautiful Bill has officially passed both houses and is now law. While some may argue on the use of the term beautiful, most everyone agrees that it is big. This legislation includes several provisions that will have a direct economic impact. For instance, it makes permanent the tax breaks from the 2017 Tax Cuts and Jobs Act. It also increases the SALT deduction cap, provides deductions for qualified tip income and overtime pay, and expands the child tax credit. Furthermore, it includes an increased investment tax credit for semiconductor manufacturing facilities right here in the U.S. All of these measures are designed to put more money into consumers' pockets, potentially boosting the economy. However, we must also contend with the unfortunate reality of deficit spending. This bill will contribute to a rising debt level over the next decade, absent other spending or revenue adjustments. As many of you know, I'm not a fan of deficit spending, and this aspect of the bill, while entirely expected, remains disappointing. Looking ahead, we see 2025 as a year of growth, albeit more muted than initially forecasted. While the pace may be sluggish now, we anticipate it will pick up as we move towards the end of the year and into next. This outlook leads us to believe that multiple rate cuts are unlikely. However, we remain open to the possibility that tariffs could prove more injurious than currently expected, which could potentially lead to a couple of rate reductions. We also foresee consumer spending gradually rising over the next few years, providing crucial support for growth. Additionally, consumers are currently saving money at the gas pump, freeing up funds that can be redirected to other sectors of the economy. Another area we're closely monitoring is the simmering potential for inflation. Tight labor markets, coupled with a growing economy, along with the potential for increased input costs due to growth and supply chain issues, create a formula for rising inflation. We would expect to see this beginning next year if our thesis holds true. On a positive note, we are very pleased with how our individual stock portfolios have performed throughout both the recent downturn and subsequent recovery. Our fixed income holdings continue to perform at or above our expectations for this current cycle, and we anticipate a good year for them as well. Now, with that being said, it would also not surprise us to experience more volatility amid lackluster data still this year, and we would not expect this to be a long-term cycle event. So, to recap, in this video, we've covered current markets and economic conditions, the big beautiful bill and some of its economic implications, our projections for the economy and markets, and the potential return of inflation. If you have any questions, please don't hesitate to contact our office. As always, we thank you for your continued trust.